Welcome back. Well, we've certainly had some volatile trading days over the past week or so. Wanted to take a quick look again at one of the indicators we spoke about not too long ago. We call this a 30-day score indicator. Essentially, it calculates number of the past trading days that were either positive or negative, and it doesn't matter if the market was up 30 points or down 200. It simply makes note of whether the market was up or down for that day. And if the market was positive for the day, it receives a score of +1. If it's negative for the day, it receives a score of -1. And we take a look at the past 30 trading days to calculate this. So, for example, if Monday the S&P 500 was up 10 points, that'd be a score of +1. On Tuesday, it was up 55. It'd be a score of +1. We add the positives and negatives together. So, for example, in this case, we'd have a score of +3. We'd have 4 up days and 1 down day. So 4 minus 1 equals 3. So taking a look at what this means for us, over the past couple days, we've seen a dramatic reversal, S&P 500 to the upside. Now, of course, yesterday we had a big down day, in part as a result of the election results. But today, a less than expected consumer price index report. Now, the CPI is still rising. Inflation is still rising. It just rose less than analysts expected. And so for that reason, the stock market's up big. So right now we have a rolling score of -5. And we can see, going back to November 3rd, November 2nd, we had a score of -11. So that certainly has improved. This is what it means for us. Statistically speaking, and take a look at the green dots, that's the rolling maximum 90-day performance that we could expect to see at any given point. So right now we have a score of -5, and this actually shows us that we're in one of the more optimal points, meaning that the market was very weak and it looks like it's starting to come back. Historically speaking, over the next 90 days, at least according to what the data suggests, we could expect to see the S&P 500 move up another 5%, which is a pretty big amount on the index. Now remember, we had a score of -9, -10, -11, and that reaches the point where the score is so negative, it actually shows us we're in a full-fledged bear market, which I don't know if, at least by the numbers, we're there right now. I don't think so. So we're actually in an optimal spot right now between a score of -7 to -5, -3. Now, as the market continues to rally higher and we start to see the positive scores, logically, the more the market goes up, the less we can expect it to go up. But right now, we're right in the middle of what we'd consider to be a very strong recovery from weak markets. If the market does continue and we're able to see scores of +7, 8, 9, 10, then we could again be at a point where we expect to see a very strong market. There's a little bit of a lull when the score turns just barely positive. And again, as of yesterday, November 10th, or actually, I'm sorry, as of today, November 10th, as of yesterday, November 9th, we have a score of -5, which indicates, we stand a pretty good chance to continue higher. At least that's what the data suggests. Now, moving to the bond market, which I think tells a much more accurate story of the current economic conditions. Stocks move in anticipation of, greater corporate earnings, but the bond market really shows us the overall strength of the economy, or the expectation of the economy and its strength. So right now we see the short-term yields of 1, 2, 3, 5-year yields are selling off. That means the prices of these bonds are rallying. Yields go down, prices go up. So traders are buying the short-term bonds, and this is an absolute reversal from what we've seen over the past couple months, where we've seen these short-term bond yields, especially the 1 and the 2, have really soared, especially in comparison to the 10-year bond yield. So we see the money's moving back into the short term. There's a resurgence of confidence into the short term, into the near-term future. And I think that's why traders are buying these short-term bonds. Taking a look at the top right-hand chart, the red line shows us the total bond yields. If we were to add up the 30-year yield and the 20-year and the 10, all those together, that would give us the red line. And that has been almost a near straight line up. The blue line represents the S&P 500, much more volatile. Now the bond yields were going up as the S&P 500 was going down. this is what's curious. Now that stocks seem to be mounting some sort of significant reversal, maybe we would expect bond yields to reverse, at least according to what the data suggests, but that's not really the case. Yields continue to rise. Now remember, yields before were going up in anticipation of higher interest rates to fight inflation. But now we see, at least according to today's CPI number, maybe inflation is waning a little bit. It missed expectations. Would that not suggest that maybe the Federal Reserve is less likely to raise interest rates? At least from this chart, it tells us I don't think the market thinks the Fed is going to put the brakes anytime soon. It's one CPI report. It is strong. It's a little bit less strong than we expected it to be. But it certainly is still marching ever so higher. Take a look at the comparison between the 10-year bond and the 1-year bond. We have currently a 0.63% or 63 basis point inversion, meaning the 1-year bond paying a 4.75% interest rate is 0.63% higher than the 10-year bond. That is still a huge inversion. That inversion has not waned. Okay, so that hasn't changed at all. So for whatever reason stocks are going up, it does not seem to be translating over into the bond market, and it at the very minimum doesn't seem to be reducing the inversion between the 1 and the 10-year bond. The green line over here shows us the net bond spreads, the difference between the 20 and the 10-year bond, the 10 and the 7, etc. And that has compressed as the bond yields have driven higher. It's bounced back to some extent, but we can see this is still very much trending to the downside over the long term at least. This is called the bond meter. The black line represents the S&P 500. Again, pretty big reversal. Notice the last time the S&P 500 was, well, a little bit actually stronger than it is now. That's going back to August of this past year. During that period of time, the green line was quite strong, but actually sold off as stocks went up. Now, the green line represents the difference between the short-term bonds, the 1 to the 2 year, the 2 to the 3 year, etc. And essentially what was happening is that stocks, as they were going up, there was more of a compression, more of an inversion, especially found in the short-term bond yields. The blue line represents the difference between the long-term bond yields, and the red means the medium-term bond yields, like the 5 and the 7 year bond yields. Point being is that when the stock market was very strong this past August, we could see the inversion really kind of dissipated from what we saw going back to July. It also has dissipated from what we saw in October. Meanwhile, the blue line, the long-term bond yields, the difference between those long-term bond yields is starting to expand, at least away from the medium term. And essentially what this is showing us is that the stock market improves. There's more of a spread between the long-term bond yields. There's more activity. There's more of an interest. Traders are willing to, buy the shorter-term bonds, the 20 years, more than the 30 years, driving the 20 years, a little bit, the yields down further than a relative comparison would be the 30 years. Now, taking a look at the correlations, very strong correlations. The black line represents the S&P 500, and the orange line represents the 30-20 spread. Remember, this is really coming back to what we consider to be some sort of a normal economic condition, meaning that S&P 500 goes down, the 30-20 spread goes down. Now that the S&P 500 is marching higher, the 30-20 spread is marching higher again. So we are seeing this longer term bond market activity, I would say start to normalize. We could compare the 1 and the 2 year bond spread to the S&P 500, and I think we're going to see a little bit of a difference along the way. See here we can see the black line again, the S&P 500, massive difference and not really any strong correlation, I would say, at all between the blue line and the brown line, which represent the 2-1 spread and the 3-2 spread. So the short-term bond yields are not moving at all in line with the S&P 500, whereas we can see the 30-20 spreads are much more aligned. And I think this probably tells us a very, very interesting story in the sense that the activity, the correlations are really locked to the long-term bonds. Perhaps that's telling us that the macroeconomic picture in terms of the S&P 500 and the longer-term bonds is more consistent. The short-term bonds seem to reflect more of the immediate change in sentiment. Now, again, the CPI, it missed analyst estimates, and that's why the stock market's so strong. But we can see the CPI is still moving ever so higher. There doesn't seem to be any change in this, as well as the PC, the personal consumption expenditure, similar to the PPI, but it allows for greater substitution in their measurements. In either case, inflation is still marching ever so higher. If we take a look on the inside, and analysts, they really they dive very deeply to see why the inflation numbers are moving. On the very surface, we can identify the gray histogram bars that shows us a 30-day performance. What has been the best performers over the past 30 days? Kerosene, diesel, heating oil, gasoline to a lesser extent, and some of the worst performing markets, I would say, are the NASDAQ volatility and VIX, the volatility index, and that's certainly very expected. As stocks go up, the hedging instruments like the VIX tend to go down. So we can see the CPI is rising. And again, analysts will dive very deeply into these reports to see what component of the CPI is moving. But we can see right on the surface, energy seems to be very strong. We should take a look at energy. If energy continues to rise, maybe we'll see the CPI start to beat expectations again. If it starts to wane, we may see a real reversal, and maybe even enough of a reversal in the inflation numbers to lead the Federal Reserve to want to pause their interest rate hikes. But I would say energy, especially kerosene, diesel, and heating oil, I think those are definitely factors that we're going to have to watch very closely in the near-term future. We hope this has been helpful. We look forward to seeing you back soon.